and gentlemen, Graeme Holm here, aka Australia's original money mentor, and it's an absolute pleasure as always each week to introduce you to the brilliant Dr. Andrew Wilson. I won't cover off his credentials. Most of you by now should know who he is and the amount of weight, his accreditations and his experience. He's definitely well versed as a talking head in the industry, and his knowledge, his degrees, his accreditation cover all of that. So let's not muck around. Good morning, Doc.
Yes, good day, Graeme. How are you? Of course, we're now into the second week of November, and I think that big fat guy is going to be coming down the chimney pretty soon. So
I don't fit these. Oh, you mean Santa Claus? I don't fit down the. Are you growing a bit of a mo for November, Doc?
No, I always have had. It's just very light, and
okay.
It's a little bit grey these days. But yeah, it is November as well, and we're past Melbourne Cup Day, and that means that really we just really fall away very quickly to the end of the year. We've really only got 4 weekends left or 5 weekends left of auction activity. So the market's winding down to some degree, although we will have, quite reasonable numbers of offerings in our auction markets over the next month or so. But it's certainly been a really, I guess, some degree a surprising spring, Graeme. The doomsayers have, I guess, have to rethink their script to some degree because markets have certainly picked up generally over spring, and particularly Melbourne and Sydney have picked up.
I've seen our mate Harry Dent on the media recently saying, I was right once.
Really?
I predicted this in 1990 something. I don't know. It was quite interesting.
Well, he's made a career out of that, whatever the correct year was. But he certainly hasn't been consistent in terms of getting it right. But, there always seem to be people who will give time to the doomsayers, even if they're, just completely off the mark consistently. But, that's human nature perhaps. But if you're involved in property, I think that, you've got to be a lot more rational when it comes to projections of Australia's housing market. And of course, Australia's housing market is certainly characterised by being robust and resilient. And we're seeing that resilience right now.
It sure is. Well, let's talk about that, Doc, because we've seen the clickbait and we hear the doomsdayers, but they're never really accurate. And if they are, it's temporarily, maybe in a 12-month period. And then we seem to have exponential growth following that correction period. So it seems to be a null event.
Well, that's why it's called a cycle, Graeme. And it's, I think one of the interesting things when we think about the housing market cycle and we look at and we haven't got this chart today, but we'll just have a quick chat about it if you like. When we look at the longer term cycles, we can see that obviously interest rates are important in terms of what they do to house prices. And the reason they're important is because that, as interest rates rise, you can't afford to pay as much with a given income because you're paying more for your mortgage. So that constrains prices growth. And the other point to that is as interest rates rise, it obviously creates a lot of negative conversations about, house price crashes, etc. And of course, the whole purpose of rising interest rates is to quell economic demand. So that's not a good news story either. So what also happens, as well as affordability being impacted by higher interest rates, confidence is also impacted, Graeme. And we move into that, what we've called here, the phobia environment, which is fear of being involved. And what that means is that, buyers and sellers are obviously spooked by a lot of the negative commentary and they sit on their hands, particularly during the early period of higher interest rates when the interest rate cycle changes. But as the air clears, the clouds lift, as typically happens, particularly in a chronically undersupplied housing market such as we have. Once those clouds lift, people get on with the business of life, and that's, of course, buying and selling property. And what that means is that a lot of that phobia energy, fear of being involved, is released. And we call that pent-up demand. And that's why when confidence starts to return to the market, we see a lift in prices, which is greater than the decline in prices when we get higher interest rates.
Let's just repeat that, Doc. So when interest rates go down and there is a decline in capital city or national house price averages, when interest rates go down, after that, the energy that occurs, the values increase, did you say quicker or higher than what they decreased?
Well, we have more demand because we've got to, not only do we have the sort of the real-time demand, but we also have the pent-up demand that's been released through that previous period of higher interest rates. So that's part of the cycle. And that's why when we look back over the growth rates between the higher interest rate periods and the lower interest rate periods, we typically see much stronger growth during the lower interest rate periods than the higher interest rate periods. And of course, there are other factors. As I said, we have generally undersupplied housing market. So, actual properties are at a premium because there's a scarcity of them. So, as I said, once particularly confidence, which is obviously a key driver in housing markets because of the importance of, purchasing a home. It's the biggest, the most significant activity or purchase that a consumer typically makes in their lifetime. So it's not something that's treated, without a lot of concern. And when there is some doubt in the economy, when there's some doubt around interest rates, you tend to get that. Holding back of demand. So, and then that's released when things look a bit clearer. We're not really probably generating the same pent-up demand this time around, Graeme, and that's because we're not having the same type of phobia environment. Certainly buyers and sellers are sitting on their hands and have been through winter, but we're certainly seeing that lifting a lot quicker than many anticipated. And that's what we're seeing in our auction clearance rates, which we look at every week and which are a really important forward indicator of what's happening in those auction markets and what it means for the housing markets generally. So just a sense of where we are going forward and the importance that the interest rate cycle has and how that it has a much more profound effect on the upside than it does on the downside. And as we've discussed a number of times, Graeme, we know that's reflected in the official data, which shows in the modern era, the worst decline that we've had in national house prices on a calendar year basis, and that's measuring December quarter to December quarter, was just 5.5%. And that was back in 2018. So over the year 2018, we dropped, which was a similar period to what we're going through this year, followed a big boom, 2017, some higher interest rates, a credit squeeze, pushed the market down, confidence fell. There was a lot of negative press, 40% falls in house prices, all those type of loopy.
And let's be clear, Doc, that was primarily macro-prudential regulatory impact. It was, hey, yes, we think the market's too hot. We're going to jack interest rates 1% for investors, except I was left scratching my head going, okay, you want to slow the current market down, so put interest rates up 1% for investors. But what about the properties I acquired 10 years ago? Now you're going to let the banks backbook me and make 1% margin on all my existing assets?
Yeah, and of course, the theory behind those macro-prudential policies, Graeme, was that we had too many investors in the market. And really, when you looked at it in isolation, markets in isolation, it really was the Sydney market where we had a lot of investor activity and a lot of international investor activity. Remember, we had that apartment boom happening there in 15, 16. And if there was and in fact, investor activity in New South Wales, meaning Sydney at that time, was around about 60% of all activity, which is a very high number, record number of investors in the market. So I guess if there was a case to say, well, there are too many investors in the market, it was for the Sydney market. But we had nothing similar happening in any of the other capital city markets. But they all had to pay higher rates, mate. Yeah,
I mean, people in Tasmania and Launceston and Cairns, everyone copped it when they could have literally, the lenders could have applied it to New South Wales or Sydney CBD and outer fringes. It's a little bit, anyway, it's a little bit interesting to me that the bank got 1% margin across their entire investment book nationally.
That's right.
To slow down the Sydney market.
Yeah, that's right.
So then now today you go, we're in a housing crisis.
That's right. Yeah. And that's the point that, if we want to look at part of the genesis for our housing crisis at the moment and, this terrible position that tenants are in, it's because we constrained perhaps all those investors at that time. And it wasn't just investors that were constrained, Graeme. It was also developers that banks also took a position against developers as well. So it's beware the law of unintended consequences. Of course, the whole theory behind those macroprudential policies back in 2018 was that the APRA, Treasury, the Reserve Bank, the government, they're all cheering on the absolute certainty that we were going to get higher interest rates just around the corner. And that was their justification for squeezing investors, was that, they're going to be in big trouble when we get higher interest rates, which is probably going to be tomorrow. And, of course, it just never happened. In fact, the Reserve Bank did that huge 180-degree U-turn from its predictions of the next move will be up and slashed interest rates in the back half of 2019 because they clearly got it wrong, Graeme. Wrong. And the whole, outcome to that, to a certain degree anyway, has been that we've, run out of rental properties here. So it's all about, sort of hitting the investor on the head, get the investors, they, stop first home buyers getting into the market, all nonsense, of course, because investors provide 40% of housing in this country. Mm-hmm. And, what we're seeing now is a reduced number of investors or reduced investor activity is now creating this very severe shortage of rental properties in Australia. So again, the APRA are there to manage risk, fair enough. We've got to manage the financial sector. That's fine. But this loopy macroprudential policy, experiment certainly went wrong. Hopefully we never see the like of it again.
Well, it's had investors running scared, and some people have still got phobia. They're a bit scared to be involved and think, well, rates are going up now. And imagine if they did that again.
Well, rates are going up, but gee whiz, so are rents, Graeme.
Oh, yeah. Actually, speaking of, Doc, let's have a look at it all. What do you got for us this week? Because I'm holding on to my hat here because I'm getting a bit excited week in, week out because, the inflation story is not that great, but in comparison to other nations, it's okay.
Yeah, well, we discussed inflation last week. I thought we'd have just a quick update on that one, Graeme. We know that inflation again lifted over the September quarter. Inflation is at the highest levels since 1990. Of course, this is a COVID-generated outcome, and that's why we're getting higher interest rates. But one of the interesting breakdowns for inflation was actually, because one of the factors was the high price of oil, and that was because of COVID supply shortages, but also because of the Ukraine war that exacerbated that. However, it was interesting that our inflation data for the September quarter actually had a negative for oil. So fuel costs were actually a negative, not a positive. And that's, of course, because we've seen the price of oil fall, as you can see there, from those peaks earlier in the year. We saw the price of oil fall there from over the quarter, and that, of course, had that negative impact on inflation, which was good news. And we know all about that from what we saw with the roller coaster at the petrol bowser, Graeme. But, hey, have a look. We're just now starting to see perhaps signs that the price of oil will be bouncing back. So we need to keep a bit of an eye on that. It's certainly still well below where it was 6 months ago. But, the price of oil is important in terms of inflation. And I think that we would have noticed at the petrol bowser recently that the price of petrol has again lifted around about that $2 a litre mark. So we need to keep an eye on that because it's important in terms of what's happening with interest rates. But the big picture for inflation, of course, and why it's occurring is retail sales. And the latest retail sales, they were up again to another record high. And I think this is a good sign for confidence in our economy, Graeme, because consumers are still spending, dare I say, like drunken sailors. But
you've also got to have it to spend it, Doc.
That's right. That's exactly my point. This is a strong economy. People have the income to spend. They are spending it. It greases the wheels of the economy, and you can see how much higher retail sales are now compared to where they were prior to COVID. But I think firstly, it shows us that confidence is still quite reasonable in our economy, despite those higher interest rates. And we know that inflation is pushing down real wages. But nonetheless, there are a number of offsets, particularly higher savings levels, that are keeping people active in terms of retail sales. And I think this is another indication of why our housing markets are just starting to pick up again, because of that underlying sense that, things are good. I'm buying this, I'm buying that. I've got a wage increase, unemployment's low, I've got a great job, all those sort of scenarios. Phone doesn't stop ringing because of, employers wanting to employ me. So, that house down the road, gee whiz, it's down around about 10%. I'm getting in now before all the rest start to move. And particularly given all those immigrants that are going to be flooding into Australia anytime soon. But
going to create a bit of competition.
Well, that's right. And that just exacerbates our undersupply. But I think that when we look at inflation, we can see our position is comparatively better, certainly than the UK, the US and Europe. And they certainly have worse positions in terms of interest rates. We know the cash rate was increased last week, Graeme, up on Melbourne Cup Day, 2.85%. Again, perhaps a little bit of a surprise. It was up just 0.25%. I think the Reserve Bank is having a bid each way, speaking of the Melbourne Cup. Well, I think that they're thinking, okay, well, we've got to control inflation. It's not good, but, we're better than a lot of other countries. We know this is a COVID thing. We think it'll be better, next year. But we got this great economy and we don't want to be throwing out the baby with the bathwater, as I say, and cracking the economy by pushing up rates too high, because our inflation position is better than the US and the UK. We want to keep our economy ticking over as best it can with higher rates. So I think that they've gone the other way. The UK and the US have raised rates by 0.75% last week, which is their maximum sort of rate of growth, a record rate of growth that they use on a monthly basis, because they're very concerned about inflation, whereas we're just doing the 0.25% minimum increase. And I tell you what, Graeme, I know this is an outsider and we're staying with the horse racing thing. This is a bit of an outsider. I'm not going to lay odds, but maybe we won't get a rise for December.
That's a roughie if we're having a bet, Doc.
Well, let's think about that one. It'll be their last meeting. It'll be the last meeting before February for the Reserve Bank. We've got the wage data coming out next week, Graeme, which we can chat about, see how but that's September quarter wage data. So, we're going to have to watch that one carefully. I don't think because of September quarter, it'll have much of an impact on what the Reserve Bank does, unless it's a lowish number, and they might think even more comfortable, because actually for inflation, a low wage number is good news because it gives us less money to spend to push up prices and create those shortages. But just on that, Graeme, if we look at where we are now, we're at 2.85% in terms of our official interest rate. Now, if we go back to 2011, which was our last interest rate increasing cycle, we actually peaked out at 4.75. Now, we're still well below that 4.75 that we peaked out in March 11. And I think this is part of the story is our we're still in a relatively good position in terms of where our interest rates are compared to where they have been. Correct. And if you think about, if we're just going to go with those 0.25% increases, that's like we've still got 8 increases to go before we exceed what we had back in 2011.
Well, sticking with the Melbourne Cup theme, Doc, if I was a betting man, I don't think we'll get back near 4.75 as a cash rate.
I don't think we'll get to 4. I think we'll peak out in the 3s.
Yeah, I agree.
But certainly, given the predictions that have been made in terms of inflation, I think that we may end with a 3 in terms of our top position interest rates. Now, there's a lot of water to go under the bridge. It's a disclaimer here, but I think the signs are. I think if you wanted to put your money on something, the smart money would be following the data, and the data is certainly improving in terms of that. So, will we get to 4.75? I'm not so sure now. And like I said, if we're only going up by 0.25%, that's like 8 rises to exceed that, right? So and we don't, if we don't get one in December, and even if we do, we're not back until February. And maybe February will be the month where the Reserve Bank decides to say, okay, we're going to wait and see now. We're going to, if they do increase in December, which is obviously still the most likely scenario, they might say, well, February, we're just going to wait and see, because there won't be any sort of real current data coming out then. Now, we don't know what's going to happen, over the next 3 months, 2 months. Anything could happen. But certainly I think the signs are pretty good at the moment that we're at least being able to discuss rationally coming to an end of the higher interest rate environment. And we can see when we compare it to other countries, Graeme, we're still below, particularly the US, which is up at 4%, raised by 0.75%. The UK, which interest rates have been low for a while there, but they raised it by the highest amount since the early 90s, up by 0.75% also. And they're having real problems with inflation there. And I would expect that to continue to rise. So we're still pretty well positioned when we compare it to the rest, similar economies, and we're only increasing by those 0.25%. So all power to the Reserve Bank. I think they're taking a bit of an even-handed approach to monetary policy.
I like it.
Yeah, in the face of what are very challenging times, let's be clear,
Absolutely.
in terms of inflation. So monthly rents, we'll want to have a quick look at the rents for the month.
Yeah, this is a good one, Doc. This is important.
Yes, it is. And we know it's important because it's very tough being a tenant out there at the moment, just about everywhere, Graeme. Sydney rents, of course, this is the October rental data, full month of October. We do show the week-to-week rents, but this is the full monthly rents. Sydney, no surprise, top capital city for house and unit rents. This is interesting, Graeme. We're still seeing a flat position for house rents over the month. So house rents didn't move in Sydney, Melbourne and Brisbane, down a little bit in Adelaide, up in Perth. But Sydney, Melbourne and Brisbane, we saw, again, a flat result for house rents. Now, I don't think this is because there's any less demand. I think what we're seeing clearly here is that tenants just can't afford to keep paying these extremely high rents. So what's happening is the tenants are now gravitating towards units. And you can see there that house rents were flat, Sydney, Melbourne, Brisbane, but they increased over the month for units. And some strong results there, particularly in Brisbane. And I think this is because, tenants say, I can't afford a house. I've got to look for a cheaper option. And that means the unit. And I think this is what the data is telling us, Graeme, of that shift towards a more affordable unit rental accommodation. And that, of course, is now pushing up unit rents. And we may get to the position where unit rents are the same as house rents, Graeme.
And we're seeing medians for unit values increase pretty strongly in a lot of places as well.
That's right. And if we look at the annual position, this is just a nightmare, really. Think of a tenant, you've got to pay these sort of increases over a year. Big numbers for houses, but look at unit rent increases over the year, Graeme. This is the year October versus October 21.
Melbourne, Doc. Melbourne that struggled through COVID in those inner city apartments. 21% almost.
Yeah. And of course, Melbourne and Sydney are going to house or try to house waves of migrants, waves of international students, and that I think we're already seeing the impact of that. And those increases in rents are just a nightmare. So where are we going to house them? People can't afford to keep paying an extra 20%, Graeme. This is the point. We're not going to continue to see this. But the other issue is the proportion of incomes that tenants will be paying for their rents, right? It'll be, 50+%. And there's nothing, it's not like when you get a mortgage, the banks are very strict about your repayment capacity. A tenant can repay as much of their income as they see fit. It's up to the landlord to accept that. So if you have to, you've got to really start to make sacrifices to pay your rent and just to get into a rental property. But they're just amazing increases there for rents over the past year, Graeme. And no surprise, of course, vacancy rates are low for houses. They're all at or below 1% and falling. And even similar, almost the same results there for units, except for Melbourne. But Melbourne, if we remember, was up around 6% not that long ago, vacancy rate, but it's fallen now, and it fell from 2.1 to 1.7% over the month. So no wonder their rents are rising at 20% a year.
Decent absorption rate.
That's right.
I don't know where Mr. Dent claims we're going to have a crisis from when we've got such low vacancy rates and such lack of supply with rents going through the roof. Anyway, I whinge about it every week, but I just scratch my head when you show us the data. I get confused at these people.
Well, if Harry Dent's want to focus on making some silly predictions regarding the US housing markets, because they're going through more or less the same that we are, with a chronic shortage of rental property and a chronic shortage of accommodation. Yeah. And these things are structural. There's nothing can really be done about it except perhaps governments making aspirational targets, which is, great. Great
we should be in government. We can just make aspirational targets. If we don't hit them, well, we aspired to.
Yeah, we're doing the right thing. It's a great soundbite, but, we need houses on the ground here, and it's just too tough to match supply with demand going forward, underlying supply and demand. And this isn't just opinions or commentary designed for clickbait, Graeme. This is just the data. You look at the data, and look at all the data that's provided by all the sources, and you'll see the same old story. And even the government's speaking about that. So that's our rental markets, Graeme. Let's have a quick look at weekend auction markets. Again, we keep pointing out it's a good forward indicator of what's happening on the ground in real time in our housing markets. You can see how Sydney house prices track clearance rates. Again, we mentioned 2018 being a similar period to now. You can see how clearance rates were well below where they are now in Sydney in 2018. In fact, they were in the 40s. And now we're starting to, which we'll see in a minute, almost double that. Well, not double that, but we're certainly a lot higher. Same story in Melbourne, house prices versus clearance rates, strong relationship there. Again, the Melbourne clearance rates now are well ahead of where they were during 2018. And of course, during the lockdowns, you can see how low clearance rates got there. In fact, they were basically zero because there was no auction clearance rates because there was no auction markets during lockdown in Melbourne. Now, last weekend, Graeme, look at the Sydney market. We've been talking up the Sydney market for a while now. We're not talking it up, but pointing out the lift in the trend, and that's continuing just under 70%. As we've said, 70% is sort of the neutral zone when buyers and sellers equal out each other. And maybe we can start, once we consistently get above 70%, we start talking about shifting from a buyer's market to a seller's market. So there were actually higher numbers of auctions, 10% lift in auctions in Sydney over the week, near 10%, and a higher clearance rate. And of course,
so a good amount of stock on 635, 615 the week before. Good volume of stock on the market and a higher clearance rate. Melbourne the same. Obviously, Melbourne Cup week earlier, 485 at 61, but 672 at 63 and a bit. They're phenomenal.
Yeah, well, a big bounce back from Melbourne, of course, but we've got to point out that Sydney rate. That's really setting back a lot of the doomsayers now, Graeme. Of course, we're moving to the back end of the season now, and typically we have more product in the market, on the market, so clearance rates tend to ease a little bit. But even getting to that sort of a high 60s number is an achievement in itself. It's certainly not the crashing market that we had in 2018, at the end of 2018, when we had clearance rates in the 40s. We're pushing towards 70, and it's consistent, Graeme. We're seeing this rise weekend after weekend. As I said, there'll likely be some seasonal downward pressure over the next few weekends to the end of the year, although there's plenty of momentum in the Sydney market, so let's not talk it down too soon. But Melbourne bounced back in terms of numbers following Cup long weekend holiday. Clearance rate, not too bad. Again, above 60%. However, it was probably a little lower than where we've seen Melbourne tracking. Melbourne's been, prior to the Cup weekend, was tracking in the mid-60s. So it was just a little bit lower. So we need to keep an eye on that Melbourne market just as a bit of a side view to see if what the results are this weekend. So that'll be interesting. Brisbane, as we said, is up and down like a yo-yo. We don't get a lot of results coming out of Brisbane, but that Brisbane auction market tends to have its own peculiar nature, if I could say that with respect. But Adelaide's still the strongest market, and the Canberra market is now starting to pick up again, Graeme, similar to Sydney after having that winter trough. So certainly rising markets across the board, we could say, or generally we could say, to end the spring selling season, which I guess ends in November because that's the end of spring. But of course, it does continue on into December, the selling season. So we'll keep an eye out for those results coming through, Graeme. We can see that rising trend in Sydney, clearly rising, and has risen through July upwards. No doubt about that. And the Melbourne market rising also, but not rising as solidly as the Sydney market. And as I said, just blipped down a little bit last weekend, so we keep our eye open for that. Brisbane market down. This is November's results versus all the full monthly results. So obviously it was an underperforming weekend last weekend, so that's exaggerated that result for Brisbane. But Adelaide still rising, still strong, still Australia's strongest auction market.
It's powering on Adelaide.
Yes, it is, Graeme. And we know that with other measures as well. And the Canberra market just showing some signs of picking up now after a weak winter period. So you can get those auction results, as we remind everybody, every Saturday night, the snapshot results, and then we have the national report comes out on LinkedIn, on my LinkedIn, on Sunday morning. So asking prices, Sydney asking prices for units and houses were flattish over the week compared to the previous week. Melbourne houses and units, however, were up. So were Brisbane. And Adelaide was reasonably stable, but down a little bit with houses. Rents, interesting. We can see Sydney rents, house rents rose over the week, now up to $660 a week. So maybe that's just a short-term relief for tenants for Sydney, that those flat rents over the last month or so, and now they're starting to rise again for houses in Sydney. Other markets reasonably steady. Upward pressure with Melbourne unit rents, steady in Brisbane for units and houses, and similarly in Adelaide and Perth. Monthly sale prices, we know, we've been looking at this, Graeme, and this again shows us that the decline in house prices, and this is monthly house prices, Graeme, we can see, and this is tracking now what's happening in November so far, early days, yes, but that trend is continuing with house prices still falling in Sydney, but certainly not falling at the same rate as they were 3 months ago, 4 months ago. And Melbourne now is just at prices are down over the month so far by just 0.8%. So that's heading really towards ground zero, maybe even this year. So those trends are clear. Brisbane's still flatlining, and Adelaide and Perth really floating around about that zero mark. But no doubt that the Sydney and Melbourne house price trend is improving. It's not growing. It's still falling, but it's not falling by much compared to where it was a couple of months ago. And the trend is down month by month by month. And we know how that's how a cycle evolves, Graeme. It's not just up and down, bang, bang. It moves in a pattern. So that's showing you that demand is rising in the Melbourne and Sydney housing markets. I just thought I'd pop in average days on market here. the latest data is also correlating what we're seeing in Melbourne and Sydney with average days on market falling over the month to the 9th of November versus the same periods to the same months previously, and similarly in Melbourne. Again, reinforcing an improving market. Of course, average days on market is a lot higher than where it was earlier in the year, but that's when we had a much stronger market, of course, and demand was high. But certainly another correlating trend to support improving market activity. So that's it for this week, Graeme.
Bang on, Doc. That's, we can see some really clear trends that you and I have been talking about, not predicting and forecasting, but giving our thoughts and opinions based on the data set we're discussing. And they really are fall in line with the trends of the data. That's cycle.
Well, that's what we do. I mean, you look at history, that tells you, at least that gives you a guiding post, and then you get the data, and you want to find data that's as close to the event as possible. And reliable and robust data. You know, it's one thing to talk about quarterly house prices, but that's looking back 3 months. And, you know, those sort of models also rely on, a large-ish data set to be reliable. But we use a number of data sets to explain what's happening in our housing markets. And we've really, it's in a way a positive experience, Graeme, because we've actually been saying these things for a couple of months now, and the data is clearly supporting it.
I tell you what, Doc, I think you're pretty close. I think Melbourne's going to be back to neutral ground zero by Christmas, New Year's.
Yeah.
And Sydney's going to be a hair behind it. You know, and that summer energy of people out and about and holidays and New Year, I'd be confident that Melbourne, like you said, Christmas, New Year's back to ground, and Sydney maybe a month to a quarter behind.
That's right.
I think looking forward in the new year, at the current trends of the data, the only way is up slightly, moderately, but slight, not exponential growth. But we know after these corrections, it grows quicker up than it went down.
That's right. That's right. And
so guess what, boys and girls, if you're listening week in, week out, and you're sitting on the fence, I reckon by like Easter, you'll be paying a lot more for a home in Sydney or Melbourne than you would today. Do you think, Doc?
Well, that's right. And you've got to ask yourself, will I have the choices that I have at the moment, or, because there'll be fewer properties available and there'll be more buyers out and about. So there's more competition. But, we've got a lot of water to go under the bridge. Let's hope it all pans out positively. Our economy's just kicking goals, doing great. I think this might sound a little silly, Graeme, but we really worked our way as a global leader through COVID, which was not a good experience, but we led the way. And a lot of it, I think, was Australians did the right thing, and they sort of disciplined themselves. And to a large degree, I think that we're sort of following that pattern again through this sort of higher interest rate inflation period. And I think that's, one of the, we have a disciplined financial sector, and that's part of the key to why we're not seeing, the issues in our housing markets that other countries have and similar economies have. But, it's always a weaker period to end the year. Typically, it may buck that trend only because people get a bit more anxious to sell their property before the year closes out. And people who are buying tend to think, I'll wait till next year sort of thing. But certainly the trends are holding quite well now into November, and we'll wait with bated breath, Graeme, what happens.
I'll tell you what, Doc, you've given me some confidence. I'm going to put an offer in on a property at the end of this podcast YouTube. I'll keep everyone updated next week if I'm successful or not, because I'm feeling confident. I'm trusting in the data.
Well, how can you go wrong with Australian property? Seriously. I mean, when you look at the trends, the longer terms, and it is robust and resilient and, dare I say it, reliable. So good luck, mate. Yeah, let us know.
I'm the winner chicken dinner. We'll see. Thanks, Doc. Look forward to catching up next week.
Thank you, Graeme.
So if you need help or you need to find out more, go to money-mentor.com.au and use the discount code podcast1500. So instead of $19.97 for a weekend full of experts, economists, financial planners, accountants, asset finance, you name it, then go to money-mentor.com.au, use the discount code podcast1500 and it'll drop it from $19.97 to just $4.97. That's $19.97 to just $4.97.